The primary topic in this video will be the identification of possible causes of stagflation, one possible scenario developing within the next year, and to do so in real time, and to adjust a portfolio when and if those factors start to appear in the economic data. I started to invest in stocks in the late 1960s, with my first purchase being HCA around 1968 when it owned one hospital called Parkview near Vanderbilt University. The company later went private and then public again. Throughout my 5+ decades as an investor, primarily a stock investor and now primarily a bond investor, I have periodically formed an opinion on the major forces that drive economic growth and profits of U.S. publicly traded companies and major stock index valuations and individual stock valuations. The two primary forces are inflation and interest rates, which are related to one another. I started writing a blog in October 2008 that periodically discusses those powerful long-term forces that drive markets up and down for an extended period of time. The initial focus when I started the blog was explaining why I had substantially reduced my stock allocation in 2007, providing snapshots of many of the trades. And I discussed in a few posts major allocation changes that I had made starting in the late 1960s when I started to invest in stocks, and for the several decades after that. I discussed that process in a blog post published on 12/11/2008 titled Static v. Dynamic Asset Allocation, where an effort is made by me over a long period to shift money in and out of asset classes based on an opinion about the big picture events that drive markets up and down over long periods of time. Part of that process involved using cash that I had built up prior to 1982 and had invested in CDs and other short-term securities that were yielding at the top over 15%, so I was able to rapidly accumulate capital through those investments. And then used a good chunk of the cash to build the home that I now live in during the 1982 recession. I had concluded by 1982, the summer, that problematic inflation that was the underlying primary cause of a 15-year plus bear market in stocks had been solved by the Volcker Fed. It was just that simple. It did not require much thought, just an observation of what was actually happening in the real world. Interest rates would fall dramatically in response to taming of inflation, and that is what happened. The stock jocks recognized it before the bond ghouls. The bond investors were pricing the 30-year treasury bond at 14% in 1984 when inflation had already fallen down to the low single digits. So they had it wrong, and the stock investors had it right by starting a bull market in stocks in August 1982. The bear market, as I've said in the past, that was caused by problematic inflation and very high interest rates, started in January 1966 and lasted through July 1982. And this is what happens when things go wrong with inflation. The average annual total return for the S&P 500 adjusted for inflation was minus 1.813% during that very long period starting in January 1966 through July 1982. Bonds were also in a bear market, but they started their bear market around 1950 after the Fed ceased its interest rate suppression regime that started after World War II and ended around the time of the Korean War, that suppressed the 10-year Treasury yield to below 2.5%, even though inflation in some of those years was over 8 to 12% annually. While I did not fully recognize in the early 1980s the computer revolution and other innovations would, in fact, usher in an era of rising productivity that would lower cost and restrain inflationary pressures for a long time, as would globalization, where lower cost commodity products were manufactured cheaper in foreign countries, which also had a major downside for U.S. manufacturing. A long-term secular bull market in stocks started after inflation was tamed and these other factors came into play, starting around August 1982, and it ended in March 2000 with an extreme overvaluation in the stock market. But the return over that period of time, the total average return, in the S&P 500 adjusted for inflation was 15.546%. That's an annual average total return adjusted for inflation. Inflation was tame. I discussed in my blog another major shift in the stock starting in February 2009 as I concluded that the world's central banks and governments had taken sufficient actions to avoid another Great Depression, which was on the horizon, but was still being priced into stock periods for an extended period of time, even after that calamity had been taken off the table. However, I noted in several posts at that time and for several months or maybe a year or two after that the seeds for future problems were planted in that response. Adding tens of trillions of dollars of new debt to solve a crisis caused by too much debt is just one of them. The current big picture is not as clear to me, but I do not need clarity now since I'm in an asset protection mode, trying to generate enough income with relatively safe investments that I can pay all my expenses and save and invest the rest. Long term, meaning 20 to 30 years, I'm not optimistic at all. I expect the U.S. government debt to continue its parabolic rise, with interest rates on that debt rising in the out years, as excessive new supply just simply overwhelms demand, requiring a rise in interest rates, a steady rise to offload new debt is necessary to offload new debt. Interest cost on the federal debt will soon surpass $1 trillion per year, more than the entire federal government debt in 1981. The end game, which is my extreme pessimism here speaking, will ultimately be found with failed treasury auctions where the Fed will have to come in and buy whatever cannot be sold to willing buyers, a result that is called debt monetization. My prediction is that the Trump administration will add to the annual deficit at over $1 trillion per year for the next 4 years, notwithstanding Trump's recent claim that he was going to balance the budget. The annual deficits will remain over $1 trillion per year during this term due to his proposed tax cuts, substantial increases in spending for programs favored by Republicans that will not be offset in any meaningful way by cutting the number of federal employees or cutting some social welfare type programs that are relied now by tens of millions of people who will reduce their spending in response to having those benefits cut. They're already on the edge of meeting their expenses as it is. Increased interest costs, which will continue to rise on the national debt, will more than offset whatever spending cuts the Republicans can agree on. And the cuts in the social programs that I anticipate from the Republican Congress that will be signed into law by Trump will have a negative impact on consumer spending in the bottom 2 quintiles of household income. As with all future predictions, the accuracy will be proven or disproven by the fullness of time. Some of the issues about the debt not being addressed and the deficit not being addressed by Trump are discussed in a NBC News article published today titled, quote, "Despite Dodge, Trump agenda calls for adding trillions of dollars to U.S. debt," end of quote. That was published by NBC News today. There are several possible economic scenarios that may emerge over the next year or so that will aggravate the deficit problem. Possibly the most troubling, in my opinion, would be stagflation that results in higher interest rates on financing new debt and the required constant refinancing of the existing debt over and over again until the end of days. The federal deficit debt is now over $36 trillion. The stagflation will cause a decrease in federal revenues resulting from the nominal to negative real GDP growth associated with stagflation, which is part of the scenario that I'm outlining here, and higher costs for all spending programs, including Medicare and Medicaid and Social Security, whose benefits are indexed to inflation, and annual and major increases in safety net program spending as unemployment rises, which is another problem with stagflation. I'm defining stagflation here as the onset of non-temporary problematic inflation occurring with negligible or negative real GDP growth. Problematic inflation is I'm defining as persistent annual CPI increases of 4% or higher that become embedded in the economy and are very difficult to get rid of, which was the experience in the 1970s and early 1980s. While it is impossible to predict whether stagflation will develop later this year or in 2026, it is possible to identify the potential causes and to be attuned to events that fit into those causes. Recognizing events in real time that are consistent with the onset of stagflation is the purpose of this exercise. For inflation, which is already proven, I should say, to be sticky at or near the current level, potential causes for an acceleration above 4% are easily identifiable. and would include widespread tariffs on imported products and the mass deportation of immigrants who currently fill important jobs in the U.S. supply chain. One of the major causes in the 2021-2022 problematic inflation period was the supply chain disruptions resulting from the pandemic. Significantly higher prices, particularly over a short period of time, will substantially reduce demand. You can see that for inexpensive items sold by packaged food companies, as an example, who suffered a major drop-off in volumes as they hiked prices to offset input cost inflation starting in 2021. And when the major cost increases are in expensive items, which would be the case after the 25% tariffs are implemented, and that would even cause more of a demand issue for new purchases. Since other countries will retaliate to Trump's tariff taxes by imposing new tariffs on U.S. exports to them, many companies dependent on those exports will see lower sales and will have to lay off workers, and that would pressure GDP growth down, and those would start showing up in the GDP estimates that the government releases. The implementation of 25% tariffs on a broader array of imports will cause significant price increases in automobiles and new homes, with the mass deportations in the construction sector, if that occurs, adding to the price increases in the construction. S&P estimated that the 25% Trump tariff taxes on steel and aluminum, together with the 25% tariffs on other exports from Canada and Mexico, will increase the price of a new car by over $6,000. Trump mentioned today that he was going to slap major tariffs on other types of imports, including pharmaceuticals and semiconductor chips. And that will lead to inflation, more inflation. Price increases of the magnitude that will be caused by 25% tariff on materials and products that are heavily used in the manufacturing process will result in fewer automobiles and other heavy users of steel, aluminum, and other materials. That will result in layoffs in the automobile industry, a very important employer in the U.S. economy, and the vast array of companies that provide parts to automobile manufacturers. Major price increases in materials used in new home construction, particularly when coupled with higher interest rates, would reduce demand as well, leading to fewer new homes being built and everything that goes into a new home as well, like appliances, carpets, paint, lumber, etc. The slowdown in auto and new home sales, which is something to monitor, would spill over into other sectors of the economy, lowering GDP growth and set up the possibility of a prolonged economic stagnation. The most important cause would be consumers reducing their spending based on concerns about keeping their jobs. The negative impact on purchasing power among millions of households that has already been caused by higher inflation numbers for the last 4 years, that has put millions of households already teetering on the edge of being able to meet their expenses, and much higher levels of consumer debt. And all of those factors would lead to lower consumer spending and would restrain particularly the lower three quintiles of households and income. I am starting to see many companies engage in mass layoffs. The largest number of firings which is ongoing is coming from the federal government. But there are many companies who have started mass layoffs as well. A slowdown in the economy later this year will result in more layoff announcements. The psychological impact on many consumers, millions of consumers, who read about these layoffs that does not yet impact them will be to reduce spending, which actually makes it more likely that unemployment will increase and then accelerate as more consumers who are still employed reduce spending. Consumer spending drives the U.S. economy, accounting for about 70% of GDP, as we know. So watching the consumer spending numbers is a must-do activity going forward. I just have outlined what may happen and why. The importance of this exercise is to recognize in real time whether these events are in fact occurring, and then to adjust one's portfolio as part of the dynamic asset allocation process in order to address the unfolding stagnation scenario, if that is the scenario that we are going to have to deal with in the near future. Consumer spending and personal consumption inflation numbers are reported monthly as part of the U.S. Bureau of Economic Analysis Income and Outlays reports. The next report will be for January and is scheduled for release on February 28th, which is a Friday.